Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Have you ever wondered why some stocks barely move while others swing wildly in a single day? The answer often comes down to one number: market capitalization. Market cap, short for market capitalization, is the total value of a company's outstanding shares. You calculate it by multiplying the current share price by the number of shares in circulation. If a company has 10 million shares trading at $50 each, its market cap is $500 million. No complicated formulas, just price times shares. But this single number does more than measure size. It tells investors which category a stock falls into: large cap, mid cap, or small cap. Large cap companies are typically valued above $10 billion. Mid cap companies sit between $2 and $10 billion. Small cap companies fall below $2 billion. And within small cap, there's an even smaller tier called micro cap, often under $300 million. Now here's the interesting part. Why do large cap stocks tend to move slower and steadier, while small cap stocks can double or crash in weeks? The first reason is liquidity. Large companies have millions of shares trading every single day. With so many buyers and sellers constantly active, it takes a massive amount of money to shift the price significantly. Small cap stocks, on the other hand, often have thin trading volume. A single large order can send the price soaring or plunging because there simply aren't enough shares changing hands to absorb it. The second reason is business diversification. Large cap companies usually operate across multiple product lines, regions, and customer segments. If one division underperforms, others can offset the loss. Small cap companies often depend on a single product, a narrow customer base, or one geographic market. One bad quarter, one lost contract, or one regulatory change can shake the entire business. The third reason is institutional ownership. Pension funds, mutual funds, and insurance companies prefer large, stable companies because they need predictable returns to meet long-term obligations. This steady demand acts like a cushion, smoothing out price swings. Small-cap stocks attract fewer institutional investors, leaving them more exposed to speculative and emotional trading. The fourth reason is information and analyst coverage. Large-cap companies are followed closely by dozens of analysts, financial media, and research firms. This constant scrutiny means information spreads quickly and gets priced in efficiently. Small-cap companies often fly under the radar, so news can catch the market off guard, triggering sharp overreactions in either direction. Market cap also shapes how index funds behave. In a market cap-weighted index, larger companies carry more influence over the index's overall movement, while smaller companies barely register. This means a single large-cap stock can move an entire index, while a small-cap stock, even with a dramatic swing, has almost no effect on the broader market. To put the difference in perspective, a large-cap stock might move 1 or 2% on an average day. A small-cap stock, reacting to the same market conditions, might swing 5, 10, or even 20%, simply because fewer shares and fewer big investors are there to soften the impact. It's important to understand that market cap is not the same as a company's actual cash value or its enterprise value. It doesn't account for debt, cash reserves, or future earnings potential. A company can have a massive market cap while carrying significant liabilities, or a small market cap while sitting on substantial assets. Market cap simply reflects what investors are currently willing to pay for all outstanding shares, based on collective expectations and sentiment. For investors, understanding this distinction matters because it shapes risk and reward. Large-cap stocks generally offer stability, consistent dividends, and lower volatility, making them a common choice for conservative portfolios. Small-cap stocks offer higher growth potential, but come with greater price swings and risk, appealing to investors willing to accept volatility in exchange for possible outsized returns. Many balanced portfolios blend both. Large-cap holdings provide a stable foundation, while a smaller allocation to mid-cap and small-cap stocks adds growth potential. The right mix depends on your personal risk tolerance, investment timeline, and financial goals. So the next time you see a stock chart, remember that size matters. Market capitalization isn't just a number, it's a window into how a company might behave under pressure, how much attention it receives, and how steady or shaky its price might be. This video is for educational purposes only and is not investment advice. Always do your own research before making financial decisions.